debtors and creditors. Another word for debtors and creditors could be trade receivables and trade payables. Different textbooks refer to debtors and creditors slightly differently. Okay, remember the word trade receivable talks about things that we're still going to receive. Trade payables, things we're still going to pay. So if something is still going to be paid, we're looking at a liability. If something is still going to be received, we're looking at a debtor. Right, so I'm going to highlight these two things. Trade receivables, debtors, assets. Okay, trade receivables are good from an accounting point of view. Right, why? Because assets are resources that you control. Creditors, from an accounting point of view, are bad because they're seen as liabilities. Trade payables, things we're still going to have to pay. Okay, so now we've revised that. Okay, remember the basics are important. You need to know what you're dealing with. Are you dealing with debtors or are you dealing with creditors? Right, in this particular section, we're focusing on that, the debtors and the creditors. Right, so we need to differentiate the two. Right, in order to do that, I'm going to draw a picture so that you guys can understand what's happening here with your debtors and your creditors. Okay, so obviously in the middle, you'll have the business. Businesses can be VAT vendors because businesses will collect tax and they'll pay it over to government. Well, that's always something that can be considered in all questions. Okay, the perspective will always be looking at the business, always, because you account and make decisions on behalf of the business. That's your job, okay, as a manager. Right, so when you run a business, how does a business create value? What must the business do? Hey, what do you guys think? Creating value. How do you create value? You first need to buy on credit or buy for cash, either or. Okay, I'm limiting the scope to credit because we're looking at debtors and creditors. Okay, so you first need to buy something. The purchase is going to come from who? The customer or the supplier? Who do we call this person or this party? The supplier. Right, so on this side, you'll have the supplier. Businesses need to buy stock. It needs to come from someone. And in our example, it's going to come from the creditor. Okay, that's who you buy from, right? If I buy from someone, we call them a supplier. But they're special. If I buy from them on credit, then we give them a name called our creditor. Okay, so suppliers are going to sell to the business, but the perspective is from the business's point of view. Okay, so if the business is focusing on their point of view, buying on credit gives rise to creditors. Does that make sense? Okay, and that amount could be maybe 100, let's say. Right, so I buy stock worth 100. Businesses are then going to sell that stock, but the sale comes later on. Let's first look at this half of the transaction. Okay, remember your job is to account for what happens between the business and their different parties. Party number one, the supplier. Party number two on this side, the customer. Okay, let's first look at party number one. What must we do? Well, let's put a heading. I'm going to copy paste this. I'm going to delete the first part. Okay, so we're going to focus on this half of the relationship. Right, so we're looking at creditors. Let's put all of this in red or pink. Okay, that's what you've got on this side. Right, so if I'm looking at the creditor, the first thing that you need to determine is, what is a creditor? Well, a creditor is a business who we have bought from on credit. That's important. Right, so it's what we said earlier, the buying on credit. You have to have a purchase on credit. If you don't, you'll never have a creditor. Creditors exist because there's been a purchase on credit. That's the reason why you've got them. Does that make sense? Okay, so if you're looking at creditors, the business is going to have to create the creditor. Right, creditors exist because you've created them. Right, and what is the first transaction? Well, a purchase. Do you agree? Okay, so let's start with that. Buying on credit. Transaction number 1. There are only 4 transactions that can arise between your business and your supplier. Transaction number 1 is the buying on credit. So if I'm buying on credit, what am I going to debit and what am I going to credit? We need to revise that. What do you think? If I buy stock on credit, the stock will be debited. Do you agree? Okay, because the asset will increase. Okay, it's logical, right? The more stock you buy, the more assets you'll have, so the asset will go up. Credit. Well, if I'm buying goods on credit, what am I going to do to the creditors? I'm going to increase the liability. Right, again, that's obvious, right? The more you buy, the more you owe. So if I'm buying more goods on credit, I'm going to have to owe them, okay, more in terms of the liability. The liability will increase. And if I buy, remember the arrow comes in. If we're looking at VAT, you'll have input VAT. Input VAT is an asset because you get to claim that from the government, okay, receiver of revenue. Okay, so that's what you've got here. The first step, buying on credit. Before we can even deal with the creditor, we need to create them first. That's step number 1. Right, that's transaction number 1. What happens next? Any idea? After buying, what happens next? Okay, you have to sell that item, but the sale is separate from the buying. Okay, so we're looking at transactions that can take place between you and your creditor. Let's put a heading here. Transactions between the business and the creditor. Okay, so obviously you've bought. There's a liability. Right, let me ask you this. Are you guys always happy with the stuff that you buy? Not always. So the second possible transaction that could arise would be a return. Returns to the creditors. Okay, you're going to return to the creditors. Right, purchase returns. You could even use that. Purchase returns. Something to consider. So if I've got a purchase return, well, if I bought inventory, obviously if I return it, it'll go up or down. It'll go down. So if you understand the buying, the return is actually the opposite. Okay, the liability will decrease. Liability is decreased on the debit side. Then you'll have to reduce the input VAT. Okay. You can have credit input VAT, or you could have had credit output VAT. It's the same thing. The net effect is still the same. Okay, I prefer using input VAT here because it makes sense, because you're not selling, you're just returning something that you've purchased, that you've bought. Okay, and then the last one, in terms of the reversal, would be the inventory. Asset, decrease. Okay, input VAT, I wrote increase there, that's an error, just fix it. Decrease. Right, so all of those increase when you buy, all of them will decrease when you return. Right, and the most important thing to highlight is that, the liability, because everything is going to focus on creditors. We're managing our debtors and our creditors because they're important. Okay, we need to look at that. Right, so you've got the buying and you've got the returning. What happens if you're happy with the stock that you have and you don't want to return more of it? What happens later on in the relationship? You have to pay your creditors. Do you agree? Okay, you need to settle your liabilities, right? Okay, so in the future, think about it. You buy goods on credit, some of it you return, and then what do you do with the goods that you keep? You have to pay for it eventually. Okay, you won't pay for it now, you'll pay for it later on. Right, maybe after 30 days, 90 days, whatever the case is, okay, in terms of your supplier. Okay, remember your supplier provides you with those products. That's what they do. Does that make sense? Okay. Right, so number 3, pay your creditors. That's the buying, that's the return. How do I pay our creditors? Well, let's think about it using basic logic. If you pay someone, what do you need to pay them? How do you pay someone? You need cash. Good. You need bank. You need money, right? Okay, so the only way you can pay someone is by using cash. So, when looking at a payment to a creditor, if you pay someone, your cash will decrease. So your bank is an asset, and the asset will decrease. Assets decrease on the credit side. That's half of it. Okay, will you owe more or will you owe less? You'll owe less. So your liability will decrease. And we know creditors is a liability, and we know all liabilities decrease on the debit side. Okay, in terms of basic rules. Okay. Then we need to consider something else when looking at payments. Right, do you always have to pay the full amount? No. So sometimes you get given a discount by the creditor, by the supplier. Right, because you owed them, but they say, if you pay early, we'll give you a settlement discount so that you don't have to pay us the full amount. Because they're trying to incentivize early payment. Because they'd much rather you pay early than not pay at all. Okay, so you could have a discount here. What discount? Discount allowed or discount received? Good. If you're the one paying, you're the one that's going to get the discount. Discount received, and discount received is seen as an income because it's a benefit. You get something that you didn't have before. Okay, we could put amounts here if you wanted to. You could have owed 100. You got a discount of 5%, so you end up paying 95. Okay, those are discounts. Right, we've looked at discounts before. We looked at trade discounts and we looked at settlement discounts. Is this a trade or settlement discount? It's a settlement discount, correct? Because you're settling your outstanding liability. Okay, good. There's still one more transaction. What else can happen between you and your creditor? Yes. Okay, so you buy from someone on credit, you return some of the items that you're unhappy with, and you pay them. If you don't pay them, so in other words, if you leave out step number 3, then you'll get step number 4. So what happens? Yes, there we go. Interest charged on our overdue creditors account. Okay, that's the last possible transaction that can arise between you and your creditor. So now let's think about it logically. If you are going to be charged interest on your outstanding liability, is your liability going to go up or down? It's going to go up because it's a liability that's increasing because you owe more interest. So liabilities increase on the credit side, so you'll credit the creditors. And you'll debit the interest expense. Expense increase. Right, just remember, accountants look at the recording of an expense. So before I was charged interest, my interest expense would have been 0. Now that I've been charged interest, I'm going to record the amount of interest that I'm being charged. Make sense? Okay. And that's it. Those are the only 4 transactions that can arise between you and your creditor. Okay, so creditor questions will always be easier than debtors questions because there are only 4 possible transactions that you will have to interpret. Okay, because remember, information is given and then you need to decide what happened. Did I buy? Number 1, did I return? Number 2, did I pay? Number 3, or was I charged interest on my outstanding account? Okay, those are the 4 possible transactions that relate to your creditor. Does that make sense? Okay, good. So now, let's look at the other side of the coin. We're looking at the debtors now. Let's copy paste. Okay, so on this side, let's put this in green. Great, so now you have debtors. Let's go back to our picture, our diagram. On our diagram, we've looked at this part of the diagram. Remember, businesses need to buy before they can sell. If I'm looking at the business's perspective, when I buy, am I the buyer or am I the seller? When I buy, I'm the buyer. Okay, if I'm buying goods, I'm going to be buying goods from my supplier. So you are viewing everything as the buyer. So I'm just going to add an extra line here. Okay, just to highlight that. Buyer's perspective. Right, so when you're given questions relating to creditors, you need to be thinking like a buyer. Okay, how much did I buy? And then you'll get it right in terms of your application. Okay, so just remember, buyer's perspective when looking at creditors, seller's perspective when you're looking at debtors. Because now you're not looking at this side of the diagram. Forget about that side. Just look at this side. Okay, what does the business now do? They sell on credit. Okay, so if you're selling on credit, what does that give rise to? A debtor. Does that make sense? Okay, so you sell to your customers. Your customers, as long as it's on credit, are called debtors. That's where the word comes from. Okay, comes from the sale. So customers are going to be sold goods. You, as the business, will be selling to them. If you're selling to your debtor, whose perspective do you look at? The seller. Right, remember we said right at the beginning, all transactions have 2 parties, a buyer and a seller. You can be the buyer or you can be the seller. It all depends on what you're doing. Right, remember this is one business, but the business buys from the supplier, which makes them the buyer, and then the business sells to the customer, which makes them the seller. Okay, so just keep that in mind, okay, when looking at different groups of transactions. Am I dealing with debtors or am I dealing with creditors? Okay, right now we're looking at debtors. So let's look at debtors. Let's put some notes here just to add to it. Business sells to customers on credit. Okay, let's make the word sell big. Sells to customers on credit. Okay, and that's the focus. That's what you're looking at on this side of the diagram. Okay, so if you know what you're dealing with, then we can look at transactions. Right, so let's show all the transactions. Let's summarize the important bits and pieces. And then we can go look at activities, okay? Number 1, what must take place between you and your customer before you create the debtor? They must buy, so in other words, you must sell. Good. Okay, so selling on credit. Okay, so before you get a debtor, you have to have a credit sale. What do I do when I have a credit sale? Well, we debit the debtors, asset increase, because they're going to owe you more. Credit the sales, income, increase. Sales is an income that's going up. And when you sell, you're on this side of the diagram. Right, so goods are going out. So you have output VAT, and output VAT is seen as a liability. Liability increase. Okay, and that's what you've got here. Okay, on this side of the diagram. Right, so transaction number 1, to create the debtor, you need to sell on credit. If you sell on credit, you create debtors. That's the first part. Right, now we need to look at number 2. What transaction can take place next after having sold something to someone on credit? Yes, you can have a return, but now the return is coming from the customer. The customer is returning goods to the business. So, sales returns from the customers. Right, or let's use the word debtors rather. Okay, we used creditors for the creditors, the purchasers' returns. Okay, I'm just using the same thing there. Okay, purchase return to the creditors, sale returns from the debtors. Right, so there's the sale. This is going to be the complete opposite. You're going to have debit inventory, not inventory, sales. We're not looking at purchasing, we're looking at selling. Okay, normally businesses want to identify what they returned versus what they've sold. So most businesses tend to record sales returns separate from sales, because then you can identify what you've sold versus what you returned, rather than offsetting them against each other. Okay, so sales returns, if the sale is income, the return would be an expense. Right, the output VAT needs to go out, or reverse out, or decrease, liability decrease. And then your debtor will decrease. Debtor's asset decrease. Right, and that's it. There's the sale. Here's the return. Again, we're focusing on the debtors. That's the key. Make sense? Good. Right, what happens next? After you've sold to the customer on credit and they've returned some of the goods, but now they keep what they're happy with. They have to pay you. Good. Right, do you agree customers have to pay you at some point in time? Correct. So, receipts from debtors. That's the next category of transaction. Okay, so if you're looking at a debtor, you can get a receipt from the debtor. If you're receiving payment, what do you get from the debtor? Correct, you get money, you get cash. So what happens to your bank? It increases. And we know bank is an asset, so we know assets increase on the debit side. Okay. The debtors will decrease because they're not going to owe me more, they're going to owe me less if they pay me. Make sense? Okay, it's logical. Right, then we need to consider the discount. Here we had discount received. If I'm looking at a debtor, do I give the discount or do I get the discount? I give the discount. So this discount is called discount allowed or discount granted. Okay, different textbooks use different wording. Okay, discount allowed would be seen as an expense, and the expense would increase when you give discounts. Does that make sense? Perfect. Right, so that's an expense, and that relates to the debtors. Right, that's very important to note. The only discount that can arise between you and your creditor is discount received. The only discount that can arise between you and your debtor is discount allowed. They're specific. Okay, it's a specific relationship, buying or selling. Number 4, if you don't collect money from your debtors, what are you going to do? You're going to start charging them interest. Good. Charging overdue debtors accounts with interest. Right, so if we're charging them, is this good or bad interest? It's good interest from the business's point of view, because the business is going to get more. And if you get more, it's an increase in benefit. And we know an increase in benefit is called an income. Credit interest income, bracket income increase. And then debit the debtors, asset increase. Why? It's logical. If you're charging them interest, do their accounts go up or down? Their accounts go up. Right, the more interest you charge them, the bigger their accounts are going to get. Right, your debtors will increase when you charge them interest. Right, there's two other potential transactions that can arise between you and your debtor. Creditors only have 4, debtors have 6. What are the other 2 possible transactions? Any idea? Good. There we go. Well done. Bad debts. Writing off debtors that cannot pay. Bad debts. Bad debts. That's something that arises only with your debtors. Okay, you don't have bad debt here on this side because that's basically saying that you don't pay. And now you can't record your non-payment. That doesn't exist. Okay, so you only record debtors that you're actually writing off. And if you write them off, you debit the expense, bad debts, expense increase, and then you credit the debtors, asset decrease. Again, we're looking at the debtor, so I'll highlight that. That's the focus. Right, that's good. Okay, you've got one of them. What's the last one going to be? What else can happen between you and your debtor? Recovering bad debts, it's a separate cash transaction. It's not a credit transaction. Okay, that's a good question. Right, I'll put a note here. Bad debts recovered is a separate cash transaction. Okay, remember, if you're writing off bad debt, the debtor's gone. Okay, you can't reinstate the debtor after you've written them off. Okay, because you need a sale to create the debtor. Right, so if bad debts recovered does occur later on, then you just debit the bank and credit the bad debts recovered. Okay, notice there's no debtors here. This is a cash transaction. This would have gone to the cash receipts journal. Because money's coming in. Yes, it came from a debtor that was previously written off, but you're not going to reinstate the account and then reduce the account. Okay, the only way you can create a debtor, as we said earlier, is to sell something on credit. That creates the debtor. Makes sense? Good. Right, the last one you probably don't know because we haven't covered that section yet. Checks that are dishonored from debtors. Right, so all the textbooks still talk about checks. Nowadays, in today's world, okay, remember with technology, with mobile apps, with the internet, with cell phone banking and all of that, okay, we don't really need checks. Okay, checks is a very old school way of making payments, but it's still talked about in some textbooks. In this textbook, it is mentioned, checks that are dishonored. Right, so let's look at that. Here, we had a receipt. So, in step 3, the debtor could have paid using a check. Right, if the debtor pays using a check, are you going to record that transaction the day you receive the check? Yes, you do. You have to. Okay, remember, the accrual basis of accounting looks at when you give rise to transactions. Okay, transactions arise. Okay, so if the debtor gives you a check as a payment of their outstanding account, you'll have to record that. Okay, this will go into the cash receipts journal. If I'm looking at a debtor that pays using a check, I need to always consider whether the check will bounce or not. Okay, they call that a dishonored check. Because what happens to the check? The business will take the check and go to the bank branch and make the deposits. And then the bank needs to process the check to transfer funds from the customer's account to your account. Okay, that's how checks work. But what happens if the customer doesn't have any funds in their account? Can the bank make the transfer? No. So what the bank does here is the bank returns the dishonored check or the check marked as RD. Okay, refer to drawer. Okay, an RD check. Right, and the bank is basically going to say, sorry, we tried to transfer money from their account to your account, but it wasn't possible. This check has been dishonored. And it could be dishonored because of errors. Okay, it might not necessarily be insufficient funds, possibly. Okay, it could be because of an error perhaps on the check. But that's just what they do. Okay, they check it and they try transfer and complete the transaction. It doesn't happen. So did this transaction actually take place? It did, but should it have taken place? Because the check was dishonored. No, it shouldn't. So when you have a dishonored check, you're basically reversing out the receipts. So what do you do here? You debit the debtors, asset increase, and you credit the bank, asset decrease. Right, and you can reverse out the discount if it applies. Reversed out. Okay, and then you could record that in your books. That's the important bit. Okay, that gets covered in a bank reconciliation, okay, which we'll see a little later.